Welcome to the newest entry in our Foreign and Comparative Law webinar series. My name is Jenny Gesley, and I'm a foreign law specialist here at the Law Library of Congress. And today I will be talking to you about central bank digital currencies, the future of the monetary system. Just a few housekeeping announcements at the beginning. We ask you that you please use the Q&A feature to submit your questions. I will try to leave time at the end for Q&A. And hopefully we'll get to all of your questions. If we don't have time to answer all the questions, you can also use our Ask a Librarian service. And I have the address for that on my last slide. So you can use that feature, or also if after the webinar is over, you have another question, you can submit those questions using that service. Trouble with your computer audio, you can also switch to phone audio. And I would also like to point out that this session is being recorded. Okay, so let's get started. This is the outline for my presentation. So I will start with some general definitions so that we're all on the same page and we all know what we're talking about. Then I will talk about central bank digital currencies in general. I will give an overview of the definition, certain design concepts, some benefits, advantages, risks associated with that, what the progress has been so far, but in more general ways. And after that, I will talk about specific examples from jurisdictions around the world. I will talk about some advanced economies, about some emerging market and developing countries, and we will see how much progress they have made and how they've structured the CBDCs that are already out there. And like I said, at the end, hopefully there will be time for Q&A. So technology and digitalization are changing the way we pay. The COVID-19 pandemic has Welcome to the newest entry in our Foreign and Comparative Law webinar series. My name is Jenny Gesley, and I'm a foreign law specialist here at the Law Library of Congress. And today I will be talking to you about central bank digital currencies, the future of the monetary system. Just a few housekeeping announcements at the beginning. We ask you that you please use the Q&A feature to submit your questions. I will try to leave time at the end for Q&A. And hopefully we'll get to all of your questions. If we don't have time to answer all the questions, you can also use our Ask a Librarian service. And I have the address for that on my last slide. So you can use that feature, or also if after the webinar is over, you have another question, you can submit those questions using that service. If you have trouble with your computer audio, you can also switch to phone audio. And I would also like to point out that this session is being recorded. Okay, so let's get started. This is the outline for my presentation. So I will start with some general definitions so that we're all on the same page and we all know what we're talking about. Then I will talk about central bank digital currencies in general. I will give an overview of the definition, certain design concepts, some benefits, advantages, risks associated with that. But in more general ways. And after that, I will talk about specific examples from jurisdictions around the world. I will talk about some advanced economies, about some emerging market and developing countries. And we will see how much progress they have made and how they've structured the CBDCs that are already out there. And like I said, at the end, hopefully there will be time for Q&A. So technology and digitalization are changing the way we pay. The COVID-19 pandemic has actually only accelerated that trend from cash, away from cash and to digital payments. And we all know cryptocurrencies such as Bitcoin are experiencing all-time highs. However, we've also seen the volatility of cryptocurrencies when, for example, the price of Bitcoin just last went after there were concerns about tighter regulations in China, and then Tesla's announcement that first that it would accept Bitcoin, then that it would not accept Bitcoin anymore. And then I saw that Elon Musk just recently tweeted again, which had an effect on various cryptocurrencies. So we can see there's a lot of volatility in this area. So actually sometimes called the Tinkerbell effect, if you've heard that term before. That means that the price will fall and rise depending on what people believe it's worth. So that if they believe, for example, now you can use this means of payment, it will be worth more, and if not, then not. And central banks are taking note of this development, that people are moving away from cash, that privately issued tokens are suddenly used as means of payment. And one of the main functions of central banks is to ensure monetary and financial stability in their respective jurisdictions, and to promote broad access to safe and efficient payments. So, and a core instrument by which central banks achieve all these objectives is by providing central bank money. And traditionally, though, central banks have limited access to digital account-based central bank money. Those are also known as reserves or settlement balances. So they've limited access to banks and certain other financial public institutions. By contrast, physical central bank money, so cash, is widely accessible to the public. But in some jurisdictions, as I already mentioned, the use of cash is decreasing with the possibility of its complete disappearance. For example, Sweden would be a prime example of this. And this would imply that the public no longer has wide access to central bank money. So, and that's one point where central bank digital currencies come in. But I should say that reasons for adopting central bank digital currencies or CBDC and the different design choices, they really depend on many different factors. And they're also different in each individual jurisdiction. And we will look at all these reasons more in detail later on. There's also differences between emerging market economies and advanced economies for adopting a CBDC. So let's talk about some general definitions. So first of all, we'll start with the basics. What is money? And money is really defined by its functions. So money has three basic functions. One, it's a means of exchange. That means that it's anything that is widely accepted as a means of payment. Two, it's a unit of account, which means it's a standard measure of value that allows us to compare the value of things. And third, it's a store of value, which means it's an item that holds the value over time. And money actually differs from other stores of values because it's readily exchangeable for other commodities. So we see from this definition, though, money can actually be anything that fulfills these basic functions. So it doesn't have to be coins and paper money, which is what we normally think of when we think about money. We think, yeah, coins and paper money. But it could be for anything, for example, cigarettes in prison, so I heard, is used as money there. It's also not risk-free store of valuable money. Inflation reduces the value of money. And if we have times of rapid inflation, people may not want to rely on money anymore as a store of value. So they may turn to other things, commodities such as land or gold. So what are the types of money that exist? There's really only two types of money. So money with intrinsic value and then money without intrinsic value. So money with intrinsic value is also called commodity money because it's backed by commodities such as gold or silver. So it's money that has value apart from its use as money. The problem though with commodity money is that the quantity can fluctuate radically and it also may vary in quality. An example for commodity money is the gold standard, which is a monetary system where a country's currency or paper money has a value which is directly linked to gold. That was, for example, the case in the US up until 1971, when the US abandoned the gold standard. And currently there's no countries that use the gold standard anymore. Then we have money without intrinsic value. It's also called fiat money. Fiat is Latin and means let it be done. That some authority, which is generally the government, has ordered to be accepted as a medium of exchange. So it's not backed up by a commodity, but by the full faith and credit of the authority that issued it. And you've probably heard that term. So currencies nowadays, the US dollar, the euro, those are all fiat currencies. I'm saying currency is the coin and paper money of a country that is designated as legal tender, which circulates and is customarily used and accepted as a medium of exchange in the country of issuance. We should also define legal tender while we're at it. This is the money that's designated by law as well as legal offer of payment for debts when it is tendered to a creditor. If you've ever looked at a dollar bill, for example, it says it on there. So if you want to take a look at that. So now we're getting closer. Digital currencies. What are digital currencies? Or digital money? This is really any form of money or payment that exists only in electronic form. So for example, deposit at banks. We all, most of us probably have a bank account with a commercial bank. So this is a digital currency. Then we have virtual currencies. And I put that in quotation marks to differentiate it from currencies that we just talked about. And how are the virtual currencies defined? There isn't an official definition, but there are several definitions that are very similar. And I'm going to take the definition from the European Union, though that's actually one that is in the law there. It says it's a digital representation of value, which is not issued or guaranteed by a central bank or public authority. It is also not necessarily attached to a legally established currency, and we'll see some examples, or some exceptions there in a little bit. It does not possess a legal status of currency or money, but it is accepted by natural legal persons as a means of exchange, and it can be transferred, stored, and traded electronically. The IRS in the United States has a similar definition. The IRS defines virtual currency as a digital representation of value as a medium of exchange, a unit of account, and or a store of value. So when we talked about the definition of money, that's what we hear here. But they say, IRS says, in some environments, virtual currency may actually operate like a real currency, but it does not have legal tender status in the US. So what are cryptocurrencies? Cryptocurrencies are a type of virtual currency, but they use cryptographic algorithms to validate and secure transactions. And those transactions are digitally recorded on a distributed ledger, such as a blockchain, and they're very volatile, which we already talked about. And the question here really, are they money? Are they widely accepted as a medium of exchange? That's really the question that's normally debated there. We know Bitcoin is probably here to stay, is more and more used. but it's still not widely accepted as a medium of exchange. So we'll see how that goes. And that's probably more an academic discussion. Then I would also like to define stablecoins, because that's also important in this regard. Stablecoins are a type of cryptocurrency that is backed by sovereign fiat currencies or other safe assets, such as the US dollar, to stabilize their value. So they want to counter the volatility of cryptocurrencies. And most of the stablecoins that have been issued are pegged to the US dollar. So in this regard, we also need to mention cryptocurrencies backed by corporations, because those are actually one of the reasons that have been cited why central banks should get into the business of issuing digital currencies. So one of the examples that probably the most important one that people heard about was Facebook's Diem, formerly called Libra. So this will be cryptocurrencies backed by corporations are backed by the asset reserves of the institution that issues them. And Facebook obviously has lots and lots of users, millions of users. So that would be quite some competition for central banks. So I would like to go to a little bit more detail here, just so, because like I said, it's a reason why central banks might issue central bank digital currencies. So Facebook was originally planning to get a payment system license in Switzerland from FINMA, the regulator there. But those plans were abandoned, and now they decided they will move the operations to the United States and only issue, for now at least, a dollar-backed stablecoin. Diem initially proposed a universal currency tied to a basket of major currencies and government debt, but then they switched to multiple stablecoins after criticism. And in the US now, the exclusive issue of Diem US dollar will be Silvergate Bank, which is a California state-chartered bank. You might be wondering why this state-chartered bank will be issuing the stablecoin for Facebook. Well, in July 2021, the Office of the Control of the Currency released a notice which letting banks provide a variety of services for assets issued on a blockchain, especially stablecoins. And it's also been reported that Diem will launch a small-scale pilot later this year. So we'll see how the public reacts to it, if it will be, if they trust Facebook enough, or if this project will actually happen. And it will be quite interesting to see. So let's move on to our topic today, central bank digital currencies. So what are central bank digital currencies? So there's no official definition of what they are. They're a new form of central bank money, and it would fulfill all the functions of money that we talked about at the beginning. The Bank for International Settlement, which is also often called the Central Bank of Central Banks, in 2018 defined central bank digital currencies as a digital form of central bank money that is different from balances in traditional reserve or settlement accounts. So they say it would be central bank issued electronic money. It would be denominated in the national unit of account. That's also important. So if it's a foreign currency, that wouldn't be a central bank digital currency. And most importantly, it would be a liability of the central bank. Even if it's issued through intermediaries, it would be a liability of the central bank and not of the intermediary. And because of all this, there would be low volatility. And in connection with that, you might have heard some academics or commentators talk about synthetic CBDCs. But those are not actually central bank digital currencies. So what are they? So it's been suggested that private sector payment service providers could issue liabilities, and those would be matched by funds held at the central bank. But here you see it wouldn't be a CBDC because the end user would not hold a claim on the central bank. But it would be a claim on the intermediary, the private sector payment service provider. So even though they're called synthetic CBDCs, they're not actually CBDCs according to the definition that I just talked about. So it's the progress so far on CBDCs. The data is from a survey that the Bank for International Settlement published in January 2021. That's actually already the third survey that they did on central bank digital currencies. And they found that it was conducted among 65 central banks. And they found that 86% of survey participants are actively researching the benefits and drawbacks of CBDCs, with 60% conducting experiments or proofs of concept, and 14% are moving forward to development and pilot projects. And what was also very interesting is that 7 out of 8 central banks that were in advanced stages of CBDC development were in emerging market and developing economies. And like I said, I will talk about some specific examples in the third part of this presentation. So this is just the general numbers, a general overview. So what about consumers? Is the public ready to adopt CBDCs? What's the most important thing for digital payments is really public trust. And I found a global opinion poll that was conducted in between October and December 2019 by the Official Monetary and Financial Institutions Forum on public trust in monetary institutions, payment characteristics, and digital currency across 13 advanced and emerging countries. And they found that in almost all countries, the respondents indicated that they would feel most confident in digital money issued by the domestic monetary authority, so the central bank. They also globally expressed actually a lack of confidence in digital money issued by a tech or credit card company. And that was particularly true for respondents from advanced economies. So that sounds like Facebook's DM would not really have a chance if central banks decide to issue central bank digital currencies. Then it was also interesting in the survey they found that across all countries, respondents were unanimous in citing safety from fraud and theft as the most important feature of digital currencies. And then second were privacy protections. And speed was actually the least important characteristic. So that's something that central banks need to keep in mind when they design their central bank digital currencies. And in general, emerging market respondents were much more open to digital money than their advanced economy counterparts. And there were also some differences depending on income, then also depending on age, and then level of education played a role. So what are some of the design choices? And this is just a very high level overview. So first of all, we have to decide, should it be widely accessible or just restricted access? Then the degree of anonymity could be ranged from complete anonymity to no anonymity at all. Operation availability ranging from current opening hours to 24/7. Interest-bearing characters, yes or no. And I will talk about this problem later. Interest could make them more attractive and similar to deposits, but they could also have influence on commercial banks. So we'll talk about that later, though. And then connected to that is the question, will there be limits or caps on individual holdings? So those are just some of the considerations that central banks have to look into. So there are really 2 models under discussion. So one is a wholesale CBDC, where access would be limited to a predefined group of users. And then we have the retail CBDCs, which are also called general purpose CBDCs, which would be widely accessible. So the equivalent, a digital equivalent of cash for use by end users. And I will focus on the retail CBDCs for this webinar, because that's the most interesting for our purposes. I would like to note a lot of central banks have done advanced research or at advanced stages of development of wholesale CBDCs, but this is unfortunately beyond the scope of this webinar. So what are some of the reasons for a central bank to adopt a CBDC? We already talked about declining cash usage in some jurisdictions. So that could be a factor. Especially for emerging markets and developing economies, improved financial inclusion for unbanked or underbanked communities is a factor, the most important factor, basically. Then in general, the interest in technological innovations for the financial sector, making payment systems more efficient, fast, instant, that could be a reason. And then what we talked about, the fear that central bank money in transactions will be replaced with private digital tokens like Facebook's DM. The question here is really the problem that they're volatile. There's inadequate consumer investor protection. So central banks really need to look into this so they can still fulfill their role. And then there's also the risk of so-called digital dollarization related to cross-border CBDCs. So what do I mean by that? The term dollarization is normally shorthand for the use of any foreign currency by another country. So let's assume, for example, in the United States, Canada issues CBDC that's highly liked by people in the United States, and suddenly everyone uses the Canadian CBDC, no one uses the US dollar anymore, and that would have an impact on the Federal Reserve's ability to conduct monetary policy and ensure financial stability. So that's definitely something that central banks are aware of and that they need to look into. So, and also, what are some of the legal, economic, technical considerations that go into developing a CBDC? And this list is by no means complete. I just put a few questions on here. The most important question probably is, does the central bank actually have the legal authority to issue a digital currency? And connected to that is the question, what will be the legal tender status of CBDCs? The BIS survey from 2021 that I talked about at the beginning found that 26% of the central banks do not currently have the authority to issue a CBDC, and 48% were unsure whether or not they would have the legal authority. So in those cases, it's probably the way the statute or wherever they get their authorization from is phrased in such a way that it could be interpreted like that, but maybe not. And the question with regard to legal tender status, if it should be replacing or be equivalent to cash, then it would need to have legal tender status. Another question is compliance with anti-money laundering and counterterrorism financing requirements. And connected to that is the question of privacy considerations. So this is a particular concern with regard to anonymous CBDCs, which I already talked about before. This is like one of the design choices. Should it be completely anonymous, or should there be no anonymity, or should it be somewhere in between? That's the fear that CBDCs might be used for illicit purposes if they're completely anonymous. On the other hand, people prefer cash, among other things, because of its anonymity. So CBDCs would have to be designed in such a way that they provide something equivalent. Then there's also the problem that there might be a so-called digital run, flight from commercial banks to central banks in times of crisis, and the risk of disintermediation of commercial banks. So what do I mean by that? We've all heard of bank runs. So during a systemic banking crisis, holding risk-free central bank issued CBDCs would be suddenly vastly more attractive than bank deposits. So there could be a sector-wide run on bank deposits to CBDCs. So this would magnify the effects of the crisis. A digital run. And the problem of disintermediation of commercial banks, so it really depends on what households will do. So if they substitute banknotes with CBDCs, then the central bank and commercial bank balance sheet will not really change. But if they, however, replace commercial bank deposits with CBDCs, then the extreme version, the digital run, then this would imply a funding loss for commercial banks. And this could lead to disintermediation of the banking sector. So this in turn would result that banks would have to try to offer better conditions on their deposits in order to protect their deposit base. But this then would imply higher funding costs for banks, which would be passed on to consumers. So you see there's a lot of things that banks, central banks have to think about. There might also be risks to central bank independence if they have a greater economic role. What do I mean by this? during emergencies, it has been suggested that a central bank could agree to act as a government agent and execute CBDC fund transfers on the government's behalf to individuals and businesses. So, for example, now during the COVID-19 pandemic, it has been suggested to use CBDCs to deliver stimulus packages to households and businesses. This also, I mean, you might have heard the term helicopter money. So this is what that is. But the problem here is helicopter money is a form of fiscal policy. And we need to separate monetary and fiscal policy in order to ensure central bank independence. So there should not be influence of politics on central bank. There should not be pressures to do certain things. So that's certainly something to keep in mind. And then in general, like that opinion poll that I mentioned showed, cybersecurity is a big issue because people are afraid of fraud and theft. So that definitely needs to go into the design of a digital currency. And then in general, also what technical solution will be chosen for the CBDC is a question. So it could be the central bank could issue a digital currency token that would circulate in a decentralized way without central ledger. It could use DLT technology such as blockchain. The problem is really all those new technologies such as DLT. Because they're new, we don't know as much about them yet. How robust are they? Central banks have been experimenting with them for a while, but they still don't know enough about it. So that's also something to keep in mind. Other ways to, for a technical solution for CBDCs, there could be deposit accounts with the central bank established for all households. And then the actual servicing and technical maintenance of the accounts would probably be assigned to one or several third-party providers, because otherwise central banks might be overwhelmed by this new task because they already have enough to do. So after all these general remarks and general consideration, let's look at some examples from around the world and what some of the countries have decided with regards to those design features. So I would like to talk first about the Bahamas, because on October 20th, 2020, the Central Bank of the Bahamas launched the first worldwide retail CBDC. It's called the Electronic Bahamian Dollar, or also dubbed Sand Dollar. And they say its main purpose is to promote more inclusive access to regulated payments and other financial services for unbanked and underbanked communities and socioeconomic groups within the country. So that's also what we saw, that this is the primary motivation for emerging market and developing economies to issue CBDCs. And in the Bahamas, the central bank didn't have the authority to issue electronic money or to make it legal tender. So that's why the Central Bank of the Bahamas Act had to be amended, which they did in 2020. And I put the legal basis here on the slide. So Article 5, paragraph 1H says that the functions of the bank are to issue and manage the currency. Paragraph 1P then says the functions are to regulate and oversee the issuance, provision, and functioning of payment instruments, which includes the issuance of electronic money. Then Article 1, paragraph 1 clarifies that the currency of the Bahamas comprises notes, coins, and electronic money. And then Article 12 says that all notes and electronic money are legal tender. So it addresses all these issues. Sand dollars are then stored on digital wallets, maintained and offered through so-called wallet providers. And I will talk about what they are in just a second. So the Central Bank of the Bahamas Act, Article 15, authorized the central bank to make regulations for the digital currency framework. And public consultation on those draft regulations took place from February 15th to March 31st, 2021. The central bank announced on their website that the finalized regulations would be issued by May 1st, 2021. However, I have not seen them published to date. They will probably do it soon, or I've just not seen them yet. So what do the draft regulations cover? So first of all, who qualifies to be a wallet provider? So they said that it's 4 groups: commercial banks, cooperative credit unions, money transmission businesses, and payment service providers. And as of mid-March 2021, 9 wallet providers have completed the cybersecurity assessments of their technology systems and have been cleared to distribute the CBDC. So, and they either use those wallet providers, they either use the Sand Dollar app, which has been developed by the central bank, or they can use their own proprietary mobile apps. And all those wallets though must have multi-factor authentication features. And no matter which app they use, they must be interoperable, or they will be at least in the future. All wallet providers must complete a robust and intensive cybersecurity assessment by an independent international firm before they can receive approval. So they're really addressing here the fears of consumers that their privacy will not be protected or that their data will not be protected. What else do the draft regulations cover? The application process to become a wallet provider, minimum standards of interoperability, what I just mentioned, then consumer protection aspects, financial stability, financial inclusion, because this is really the main purpose of the CBDC in the Bahamas, several obligations of wallet providers, wallet limits, and then enforcement powers. So yeah, with regard to financial stability, so remember that we talked about disambiguation of commercial banks, risk to financial stability. And what they did in the Bahamas to counter these fears is they said to constrain the ability of the Sand Dollar wallets to substitute for deposits at commercial banks. The central bank would be empowered to limit the amount of the digital currency that individuals, businesses, and other non-supervised financial institutions can hold. And also no interest would be paid on digital currency held in mobile wallets. On the other hand, limits on the currency also have a problem if you want them to be equivalent to cash. That could also be a future problem, but I guess we'll see how it plays out in the Bahamas. Other Caribbean jurisdictions are also very advanced already with their CBDCs. And that just confirms the results from the BIS survey that 7 out of 8 jurisdictions in advanced stages are in emerging market and developing economies. So Jamaica, for example, on March 22nd, 2021, the Bank of Jamaica announced plans for its CBDC. And they say it will be a hybrid CBDC, so a cross between wholesale and retail. And what's interesting is they said they will not use blockchain technology. They will use the existing payment system framework. They say that's efficient and enough. Also, currently, the BOJ does not have the right to issue digital currency as legal tender. So the BOJ Act amendment is also underway. And from now until December 2021, the CBDC in Jamaica will be tested. So as a pilot CBDC solution that will be tested in the FinTech regulatory sandbox. And the bank announced that they're planning on introducing the CBDC in early 2022. Then the Eastern Caribbean Currency Union is in advanced stages. If you don't know the Eastern Caribbean Currency Union, it was established in 1983, and the Eastern Caribbean Central Bank is the monetary authority there. It's a group of 8 island economies, namely Anguilla, Antigua and Barbuda, the Commonwealth of Dominica, Grenada, Montserrat, St. Kitts and Nevis, St. Lucia, and St. Vincent and the Grenadines. So on March 31st, 2021, they had the public rollout of the Eastern Caribbean Central Bank's CBDC, and it's called Dcash. And it's just a digital version of the Eastern Caribbean dollar. But currently, they did not roll it out in all the countries. They're doing a 12-month pilot in just a few countries, in Antigua and Barbuda, Grenada, St. Kitts and Nevis, and St. Lucia. So let's go to a different part of the world. Russia actually also just recently announced its plans for the digital ruble. In October 2020, they published a public consultation paper. And then in April 2021, they published a digital ruble concept based on this public consultation. And this concept describes all the specifics of implementation of the target model and the different dates. So what Russia is planning, they say by December 2021, they will create a prototype of a digital ruble platform. Then in January 2022, they will develop draft amendments to the central bank legislation in order to give the central bank the right to issue a digital currency. And then first quarter of 2022, they will launch testing of the prototype of the digital ruble platform. And all these papers, the digital ruble concept, the digital ruble, they're available on the Bank of Russia website in English. So if you would like to read more about this, you can just go to the website and read about all the details. So let's go to China, which is very interesting because it's one of the first, it's the first central bank of a major economy to roll out a digital version of its currency. You probably read about this in the news. There's several names for the digital currency. DCAP, which stands for Digital Currency Electronic Payment, then Digital Renminbi, Digital Yuan, or ECNY, but that's all the same. So currently they're doing pilot projects in several major cities, but no official nationwide launch date has been announced yet. So for example, one of the pilot projects took place in February 2021 in Beijing during Lunar New Year. They handed out a total of 10 million yuan, which is around $1.5 million. And they were distributed through about 50,000 packets of 200 yuan each, which is about $30. And recipients were able to spend the money at designated offline locations or on parts of an e-commerce website, JD.com. But those vouchers were only valid for a certain time from February 10th to February 17th. And the test was also only open to those with a Chinese ID number or with residence permits from Hong Kong, Macau, or Taiwan. And that was the third test of the digital currency. And then, yeah, other major cities, for example, Shenzhen, had similar experiments. So currently, the People's Bank of China doesn't have the legal authority to issue digital currency. And the law needs to be amended. So that's why on October 23rd, 2020, the PBOC released draft revisions to the law for public comment. And the important article there is draft Article 19. And that would say that in its amended version, renminbi includes both physical and digital forms. So that would be the legal basis for the PBOC to issue the digital currency. And the revision of the law is on the 2021 legislative agenda of China's National People's Congress Standing Committee, but only as one of the preparatory projects. And my colleague who covers China told me that means it's lower priority, so it's unlikely that it will be passed in 2021. So how's the digital currency in China structured? So the digital currency will be issued by the PBOC to commercial banks and non-bank payment platforms and other intermediaries. And those in turn will make the digital currency available to end users. And DCAP will be stored in digital renminbi wallet apps, so similar to other digital payment apps that people already have. But it's important to note, again, it would be a direct liability of the PBOC and not of the commercial bank. They only act as intermediaries, because otherwise it wouldn't fall under the definition of a central bank digital currency anyway. And what's interesting, they said it will not be blockchain based. There will be conditional anonymity, they call it. So it means privacy by design is integrated into the CBDC. So the data provided by users will be tiered. So depending on the amount, there will be different accounts. So general account, premium account, depending on which one it is, there will be more data released or not. And then data access will also be highly restricted to alleviate privacy concerns. Supposedly there will also be support for dual offline payments, which means that both payer and payee can be offline. So similar to cash then. They say there will also be support for so-called smart contracts. So let's go to Sweden. Sweden's central bank started the e-krona project in 2017. In case you're wondering why Sweden's central bank is doing an e-krona project and why they're not part of the digital euro, why they don't have the euro, even though the European Union member state. So all EU member states are part of the Economic and Monetary Union, and they coordinate their economic policy making to support the economic aims of the EU. But it's only a certain number of member states that have replaced their national currencies with the euro. And those member states form the euro area, and the European Central Bank is the monetary authority for those countries, which is currently 19 EU member states. But Sweden is not one of them, because they have not yet fulfilled all the necessary requirements for the adoption of the euro. They also don't have a target date. So they call member states with a derogation. So in Sweden, it's still the central bank, which is the monetary authority, and not the European Central Bank. So what's the purpose of the proposed e-krona in Sweden? They say they want to provide a public alternative to future commercial digital currencies. So one of the reasons that we talked about, and they also want to ensure that the trust in the monetary system is maintained. So those go together. If people flee to privately issued digital tokens, that might undermine financial stability. They say it's a technical solution that will most likely use distributed ledger technology, blockchain technology. And there's two phases in Sweden. So they just completed the first phase, and they issued a report after this phase was completed. That report, English translation, is also available on the website of Sweden's central bank. So you can look at that if you are interested. If you're familiar with our Global Legal Monitor website, my colleague also wrote an article about the report, which is available on that website, so you can also look at that. So in the first phase, the central bank evaluated what laws may apply to an official digital currency, whether or not the law of the central bank would need to be amended so they can issue such a currency. And they analyzed the different technical solutions of an e-krona in relation to anti-money laundering regulations. So the second phase will start now. In that second phase, they will bring in commercial banks and other market participants to test how it might work practically. The Swedish government has also tasked a group with investigating the future role of the national state, including the central bank in the Swedish payment market in general, and what role an official e-currency could play. But this report is not due until November 30th, 2022, so it's doubtful that we will see an official e-krona before that date. And the law would also have to be amended, or a new law would have to be passed to allow the central bank to issue an e-krona. So what about the European Union? I have this nice quote here from Christine Lagarde, the president of the European Central Bank. She said the euro belongs to Europeans and we are its guardian. We should be prepared to issue a digital euro should the need arise. Should the need arise also indicates that they haven't made a decision yet on whether to launch a digital euro project. And they said they would make such a decision towards the middle of 2021. But on the other hand, they have done extensive preparations, which I will talk about now. And also just a quick remark, if you follow European Union news, in September of 2020, the European Commission published a legislative proposal on markets and crypto assets, also called MiCA, which would regulate crypto assets that fall outside the scope of current EU financial market regulation. But there's express exemption for central bank digital currencies. So MiCA would not apply to CBDCs. Oop, that was too much. I have to go back. Okay, here we go. So in October of 2020, the European Union's high-level task force, the Eurosystem high-level task force, published its report on a digital euro. And in that report, it defined a digital euro as a liability of the Eurosystem recorded in digital form as a complement to cash and central bank deposits. That's important. They say it will not replace cash or central bank deposits, which It's one of the fears that suddenly there will be no more cash for use in retail transactions available to the general public. And then they identified possible scenarios that would require the issuance of a digital euro. So they say, first of all, if there's increased demand for electronic payments in the euro area in general, then we should issue a digital euro. Or if there's a significant decline in the use of cash as a means of payment, for example, like it happened in Sweden, if that would happen in the euro area, that would also be a reason to issue digital currency. Then they say the launch of global private means of payment, what we talked about, for example, Facebook's DM, suddenly everyone likes it, everyone uses it. Those could raise regulatory concerns and pose risk. So that would also be a good reason that the central bank steps in. And then the problem of digital dollarization that we covered, if there's a broad take-up of CBDCs issued by foreign central banks and the European Central Bank would suddenly not be able to fulfill its functions anymore. Then in April 2021, a public consultation report was published. But like I said, they haven't actually decided yet, and they will decide by the middle of 2021 whether or not they will launch a digital euro project. But I just read an interview with Fabio Panetta, who's a member of the executive board of the ECB. And he said that if we do it, the earliest date for CBDC would be 2026. So that's still a little longer until then. So not as advanced as other jurisdictions. And then one of the things that would have to be discussed in the European Union is the legal authority of the European Central Bank, because currently it doesn't have the legal authority to issue digital currency. Article 128 of the TFEU just states that the European Central Bank has the exclusive right to authorize the issue of euro banknotes within the EU, and that only such notes have legal tender status. And then the member states are authorized to issue bank coins, subject to approval by the ECB of the volume of issue. So this is, first of all, they would have to amend the law to give them the general right to issue a digital currency. And then it would have to be decided, would it be digital banknotes or digital coins? So depending on that, it would either be the ECB in charge or the member states. So those are still just some of the questions that need to be discussed in the European Union. So let's briefly talk about the United Kingdom, because on April 2021, the British finance minister floated the idea of a so-called, what he dubbed Britcoin. He floated that idea when he announced the creation of a CBDC task force between the Treasury and the Bank of England, which will coordinate the exploratory work on a potential retail UK CBDC. But they have not yet made a decision on whether to introduce a CBDC. So this is just, they're looking at different scenarios. And for that purpose, they also established two external engagement groups. So one is called the CBDC Engagement Forum, which would engage senior stakeholders and gather strategic input on all non-technology aspects. So just the practical challenges. And then there would be a CBDC Technology Forum, which would focus on the technology aspects of CBDC. So what technology should they use? But they already mentioned CBDCs would be introduced alongside cash and bank deposits. So like the European Central Bank, they want to make sure that people know that it will not replace cash and bank deposits, that it will be equivalent to cash, but it will not replace cash because not everyone necessarily wants a digital currency. So let's switch to the United States. And I have another quote here from Jerome Powell, who's the chairman of the Board of Governors of the Federal Reserve System. And he said in April of 2021, "It is far more important to get it right than it is to do it fast or feel that we need to rush to reach conclusions because other countries are moving ahead." So that shows us that the US is taking a more cautious approach with regard to CBDCs. It doesn't necessarily mean, though, that the US is not researching CBDCs actively. It just means that no decision has been made yet on whether to issue a CBDC. So for example, in August 2020, Boston's Federal Reserve announced a multi-year collaboration with MIT's Digital Currency Initiative to develop a hypothetical CBDC. And what they do there, they're exploring the use of existing and new technologies to build and test a hypothetical digital currency platform. So they're focusing here on the technology aspect. And then there's also some bills were proposed in the House and Senate last year as part of the coronavirus relief response, which would have required the Federal Reserve to create consumer accounts and deposit central bank digital currency in them. Those measures didn't pass. They were called digital dollar wallets. In case you're interested, those bills were HR 6321 and Senate Bill 3571. But like I said, they didn't pass. This is something that we talked about before when I mentioned, the helicopter money. And then there's also some private initiatives that you might have read about. In May 2021, the US nonprofit Digital Dollar Project, which is a partnership between Accenture and the Digital Dollar Foundation, they announced a launch of at least 5 pilot programs over the next 12 months to test the potential uses of a US CBDC. And the goal of this initiative is really just to generate data on functional, sociological, business uses, benefits, and other facets of a US CBDC. And so that this data can be used in research, in the public discussion, as well as inform policy considerations by Congress. They also published a white paper. So this is also something worth looking into and a very interesting development. And in some of the advanced economies, like the United States, the question or the reasons for issuing CBDC could also be just making payment systems more efficient. So the question is really, is a CBDC necessary, or can we just improve the current system? For example, the Federal Reserve is working on the so-called FedNow service, which will be a new instant payment service, which would enable all financial institutions to provide safe and efficient instant payment services in real time, around the clock, and every day of the year. So that might actually be an alternative for advanced economies if this is the only reason why they're introducing a CBDC. So if it's one of the other reasons, or if it's in a more emerging market economy and they're really looking for financial inclusion, then that would obviously not be a substitute for this. But yeah, this is just one of the considerations. Okay, so this concludes this part of my presentation. We will now move on to the Q&A. And like I already mentioned, if I don't get to your question, or if you have a question later on, you can always submit them through our Ask a Librarian service. You can see the address here on the PowerPoint. You can also just go to law.gov. There's also a link to it. And I would also like to mention our next Foreign and Comparative Law webinar on June 17th, 2021. It will be on new laws of China and how to find them online. So for example, if this presentation got you interested in China's digital currency and you want to research that more, it would probably be a good idea to attend that webinar to know how you can find Chinese legislation. Okay, so I'm going to take a second to look at the Q&A. And then I will answer those questions. So just give me a second. I see the first question, I guess we already answered that. What countries are currently looking into utilizing, implementing a CBDC? So the ones I mentioned were the most interesting ones in my view. And it's really like a lot of advanced and emerging market economies that are looking into. There are others that I did not mention that are maybe in a more advanced state, but those are the most interesting ones, and the ones that have been in the news lately. The question, I have another question here. What would be the motivation for a private company to issue a digital currency? For example, yeah, Facebook said that they, they're a big company. They would like to, provide services to people. I mean, this has been criticized a lot. I've seen other digital currencies issued by private companies. They also mention other reasons. I can't think of the name of, I saw another one. They said that one of the reasons they would like to issue a digital currency is financial inclusion. So they're similar to the emerging market economies. So in particular, with regard to cross-border payments, they say it would help. So, the name was Silo, I think, which is a blockchain payments platform. They said their main reason was financial inclusion. The problem, though, with financial inclusion is also normally you need a smartphone for all these digital apps. So sometimes people will not have the smartphone. So there's a question if you can really achieve financial inclusion with the CBDC. So then there's a question about the fear of replacing CBDCs replacing cash or bank deposits, and the usage of credit cards. Do we know how credit card companies might react to CBDCs? I guess we already, we actually heard about this with regards. We know that a lot of companies were supporting Facebook's Libra at the beginning, or Facebook's Diem, and then after criticism decided to end their collaboration. So they're definitely interested, and they're keeping track of all this. And depending on how the individual CBDCs are structured and designed, with the different, like how, what type of wallet providers there will be, for example, then credit card companies might, actually participate. So that's something to be seen, but I know they're definitely all watching it. We've seen news that they're getting more involved with cryptocurrencies. So I'm guessing they would also be involved in some way with central bank digital currencies. Let's see. So there's also the question, what's the difference between a digital currency and electronic bank deposits? So electronic bank deposits are digital currencies. So there's no difference. It's electronic bank deposit is a type of digital currency. The question, if CBDCs are widely adopted, what would that mean to Bitcoin and other digital currencies in use? So that remains to be seen. Because the CBDCs would just be a digital equivalent of cash. So central banks are hoping that people will, use the central bank digital currencies, which are safer and a safer alternative than Bitcoin and other cryptocurrencies. So people might not, so what they're hoping is that the CBDC will be used as a means of payment and not Bitcoin or other cryptocurrencies anymore. But the thing is, it will probably, cryptocurrencies will not go away just because central banks suddenly decide to issue digital money. It's what I talked about, that as long as people think that they are a store of value, and then they will still be around, especially Bitcoin will still be around. Although the only problem with Bitcoin is, I guess, there's a fixed supply, whereas fiat currencies, central banks control the supply and they can increase it, and which they have done, for example, in recent years with their quantitative easing programs. So, I mean, what central banks are hoping, if there's a high uptake of cryptocurrencies or by the public as a means of payment, and then central bank digital currencies are issued, that people will come back to the central bank. They will not be replaced. And normally from that opinion poll, it's most likely because people trust the monetary institutions more to issue digital currency. It's most likely that people will then use them more. But like I said, I don't think it will still definitely be an investment opportunity for people. So that will definitely not go away. I see a question whether or not there's any effort to develop a global digital currency. I have not read anything about a global digital currency. And that would also be difficult because one of the definitions of a central bank digital currency is that it's in the domestic currency. So that probably wouldn't work. I mean, there's something to think about, maybe special drawing rights from the IMF. But I haven't really read anything about that, there have been, debates about that. Will the market price of the digital currency mirror the country's currency? If they will be just a digital equivalent of cash, then yes. So they will be the same. So you can either use cash or you can use digital currency, whatever is more convenient to you. I also see that are there any concerns that cryptocurrency will disintermediate central banks if the central banks don't move on issuing CBDCs? Yes, for sure. So that's really one of the reasons why central banks are looking into issuing CBDCs. And because I mentioned cryptocurrencies issued by corporations or other private digital tokens are very volatile. There's no good consumer or investor protection. So the functions of the central bank to maintain monetary and financial stability are at risk if they don't act. I see there's a lot of questions here. And it's already actually past our time. So I apologize if I did not get to your question. Like I mentioned, you can always submit your question through our Ask a Librarian service. And I will try to answer all of those. In the slides, I also included links to some of the documents I talked about today. So when you receive the slides, you can click on the documents and then read more about it. And I wanted to thank you all for attending the webinar. And we hope to see you soon again on our next webinar. Thank you very much.
From the Library of Congress in Washington, D.C.
Good morning, everyone. Thank you very much for coming on this cool day. Welcome to today's program featuring economist Tim Harford. I'm Bill Sittig, Chief of the Library's Science, Technology, and Business Division, and this event is one in our series in which we learn from important writers, thinkers, and practitioners in the various fields of science, technology, business, and economics. Before I introduce today's speaker, I would like to mention a few of our upcoming programs. On February 14th, St. Valentine's Day, our own Abby Grotke from the Office of Strategic Initiatives will give us advice from her book, Miss Abigail's Guide to Dating, Mating, and Marriage. You're not going to want to miss this event, which will feature an exhibit of 19th century books on manners from the library's collections, as well as snacks from recipes from these books. On more serious subjects, on February 26th, Paul Orfila, founder of Kinko's, will speak on the book he co-authored with Anne Marr, This, Lessons from a Hyperactive Dyslexic Who Turned a Bright Idea into One of America's Best Companies. And on March 21st, we will feature a presentation by Mark Nash, realtor, television commentator, and author of 4 books on real estate, including his recent book, 1001 Tips for Buying and Selling a Home. I hope you will be able to join us for all of these presentations. I'd also like to take this opportunity to thank Carolyn Larson, sitting in the front row here, of our business reference staff, for all her good work in preparing for today's program. Carolyn has prepared a bibliography of books mentioned in Tim's book and has assembled a display of some of these books from the library's collections. Please help yourself to copies of the reading list, which is on the side table there, and please spend some time looking through the books. It is now my great pleasure to introduce Tim Harford, an economic columnist for the Financial Times. Tim writes the Dear Economist column, in which he analyzes readers' questions using the tools of modern economics and the wit of Miss Manners. Last year, he began writing a second column, The Undercover Economist, which, like his book by the same title, explains the economics behind our day-to-day experiences. This latter column is syndicated in the U.S. magazine Slate and in Canada's Commerce. Tim was born and educated in Britain, receiving his degree in economics from Oxford. He has been a tutor at Oxford, a speechwriter for Stanley Fischer, now the governor of the Bank of Israel, a scenario expert at Shell, and he worked as an economist at the International Finance Corporation, which is part of the World Bank. He lived here in Washington for a couple of years when he worked there. I think I read somewhere that he started the first blog at the World Bank. Tim is a prolific writer. In addition to his regular columns, he has published in numerous international newspapers, including the Washington Post, Forbes, the New York Times. Last year, he was awarded the Bastiat Prize by the International Policy Network for his writings promoting economic understanding. He is the presenter on a new BBC series entitled Trust Me, I'm an Economist. And he is the author of 2 books, The Market for Aid, which he co-authored in 2005 for the International Finance Corporation, and The Undercover Economist, first published by Oxford University Press in 2006 and published in paperback this year by Random House. Tim has signed copies of this book, which are for sale right in the corner of this room here. He would be very pleased if you would use your market power as a good consumer by purchasing copies of this book following today's program. I must say that Tim is going to have to leave immediately following this program. He's going to be interviewed on WAMU at 1 o'clock by Kojo Namdi. So please, if you have questions, you will have to ask them during the program, which will have to end sharply at 12:30. I enjoyed flipping through this book. On my quick perusal of the book, I discovered why there's a Starbucks on every corner and why the prices at Whole Foods, where my wife and I usually shop, are not really much higher than at the neighboring Safeway. Perhaps Tim will fill you in on some of these secrets. It is now my honor to welcome Tim Harford to the Library of Congress. Tim.
Thank you so much, Bill. It's a very generous introduction. It's wonderful to see so many of you here. I'm very honored to be speaking at the Library of Congress. It's wonderful to be back in DC, which is a city that I'm very fond of and lived here for a couple of years. My daughter was born here. This all by way of explaining to you that economists are people too, economists are human too. But that said, I'm hopefully by the end of the time we have together, I'll talk for half an hour or so, and we'll have some questions. I hope you'll have questions. I hope you'll understand that economists are people too, and that economics is nothing if it can't help people with their personal problems. It won't have escaped your notice that in a week's time it's Valentine's Day. There is, of course, an event here at the library. I won't be here, so I'm going to try and tell you about Valentine's Day now. Nobody here will need dating advice, but you'll all have a lot of friends, I'm sure, and some of your friends may be lonely on Valentine's Day, and they may need some assistance finding that special person. And I'm sure you'll agree with me that there's nobody better to give dating advice than an economist. I want to tell you first about my experience helping a lovelorn playboy called Andy. We filmed this for the show, Trust Me, I'm an Economist. Andy's problem, I think a lot of men have this problem. He's a good-looking guy, he's charming, but women just didn't entirely trust him. There was something about him. I think it was the fact that he wore his shirt to the navel and had a medallion. But he needed a little bit of help, a little bit of extra help from economics. And so he responded to our invitation to come on the TV show. And I'm sure you'll understand the basic problem Andy had and the solution. He really needed to think of himself as a dodgy-looking DVD player languishing on the shelves of Walmart. That's what I explained to him anyway. He didn't thank me for the comparison. But when we think about the problem that the manufacturer has selling a DVD player, maybe you don't know the manufacturer too well. This was a problem that really affected Japanese electronics manufacturers in the 70s initially. And it's hard to imagine that Japanese products were regarded as being shoddy and unreliable, but they were. And how the Japanese got around this was, well, put yourselves in their shoes. You can offer a discount to the customer, but if the basic problem is the customer doesn't really know if the product is going to perform when you get it home, which I think was also Andy's problem, if the customer doesn't know that the product is going to perform, then offering a discount doesn't. Well, there are two problems. First, it doesn't solve your essential problem, which is that the customer doesn't know if you're offering a quality product. And the second problem is that even if you do make the sale with a discount, you've obviously lost money because you had to offer a discount to make the sale. So there's two reasons you don't want to offer a discount in order to get over this quality hurdle. What would you do instead? You offer a money-back guarantee, a free money-back guarantee. And this has two positive effects. The first is that it reassures the customer that if there's a problem, they get their money back. But that's not really what a money-back guarantee is about. A money-back guarantee is a cast-iron signal of quality. Yeah? Any manufacturer can say, this is a great DVD player, this is a great CD player. Anybody can say it. That's just advertising. We ignore that. But the money-back guarantee says, this really is a great product, because if it's not great, you're going to bring it back. And if you bring it back, it's going to cost us a ton of money. So we know that it's a good product. We know you won't bring it back. That's the signal. To an economist, talk is cheap, but that sort of action really proves that you've got a quality product. Now, I'm sure you're way ahead of me here, and you can see how Andy would be able to offer a money-back guarantee on a date. But just in case you don't quite see where this is going, we took Andy to a speed dating evening. You may know about speed dating. You have 20 guys and 20 girls, and they pair up and sit down at a little table, and the host who's organizing the speed dating event rings a little bell, and they talk to each other for 3 Chardonnay-fueled minutes. And then the host rings a bell, all the guys get up, move to the next table, sit down, and so you meet 20 people over the course of just over an hour. You have a little card. in a box, yes or no. And if you tick the yeses, and if the person who you were meeting also ticks a yes, at that point the speed dating company will give contact details. So it's a real, it's serious. If you tick yes and you never want to see this guy again, he's going to get your phone number. You don't want that. So you tick yes if you mean yes, you tick no if you mean no. Economists love this. It's a great way of generating information, by the way. They found out all kinds of exciting things. But on this particular occasion, we weren't interested in finding out about speed dating. We were interested in playing this game to win. We put the TV camera down in front of the speed dating table. We sit Andy down and we say, okay, Andy, here's your money back guarantee. You pick the girl you most like. You offer her 2 tickets to see the best show at the West End. This is London, right? It's like Broadway, only it's in London. We offer you 2 tickets to see the best show. You offer her 2 tickets to see the best show at the West End. Don't offer it as a bribe. Don't offer it with any conditions. Just give her the tickets. They're for a show in a month's time. And now we forget about the tickets. And you say to her, we've only got 90 seconds here just talking. I know that if you got to know me, if we went on a date, we could have a picnic in Hyde Park, we could go out for dinner, you'd really like me if you got to know me. So let's have a date. Let's give it a try. And then after a couple of dates, you're going to open your desk drawer, you're going to get out the tickets in a month's time, and you're going to look at the tickets and say, 2 tickets to see a show. Who could I possibly bring with me? Andy. Andy's a great guy. I'll bring Andy with me. So that's why it's a money-back guarantee, because if Andy performs as expected on the date, if he is in fact an engaging and likable young man, then he gets to see the show after all. And if in fact he doesn't deliver and is in fact an offensive medallion-wearing bore, then at least the girl gets 2 free tickets to go to the show with some other guy to compensate her for the evening she wasted with Andy. So really, satisfaction is guaranteed. So we put the TV cameras on him, we sat him down, beautiful girl, gave her the tickets. It was a total disaster. It was a complete catastrophe. And that's why, for all the title of the show, Trust Me, I'm an Economist, trusting an economist is something you should never do. And by the time I've finished with you, you will understand why you should never trust an economist. I hope that you'll also understand a little bit about why we have an excuse for our disreputable reason why you shouldn't trust economists. And knowing that reason helps you understand the way the economy works a little bit more. So that's what I'd like to do. One of the reasons why you shouldn't trust an economist is because, well, there's no nice way to put this. Economists don't understand the economy, it's a shame, I know. But there's a reason they don't understand the economy. They don't understand the economy because the economy is a very complicated thing. Think about, for example, a cappuccino from Starbucks, which is something I write about incessantly in my book. There's a cappuccino on the brain. And think about a cappuccino. Does anybody here know how to make a cappuccino by any chance? So we've got a lady here. So how are you with milking cows? Not so good. Yeah, I know. I get confused and everything, which bit goes where. Yeah, you could, if you're given milk and coffee, maybe pre-ground coffee, or a coffee grinder, which was designed by some long-forgotten engineer, if you're given electricity generated in some far-off place by people you don't know, with processes you don't understand very well, coffee that was grown in Guatemala and flown to you and roasted and you're not sure exactly how that process works, if you're given all those raw ingredients, then I'm convinced that you make a beautiful cappuccino. However, you're just the last... This is the final yard of a long, long process. And that's true for most products in the modern economy. I think I'm safe in saying there is actually nobody in the world who can make a cappuccino from scratch. If you just say, okay, the world is your oyster, now you have to go and grow coffee, you have to dig clay out of the ground, you have to shape it into a ceramic mug, fire it, glaze it, fire it again. You need to generate electricity. Maybe a water wheel would work, I don't know. You need to process steel and roll it into an espresso machine. You need to milk the cows. Let's go back. You need to breed the cows that produce the right kind of milk. But it's fantastically complicated, and that's true of any product, almost any product in today's economy. It is a team effort. It's the product of an amazing team effort, and there's actually nobody in charge of the team. No one in charge of the team, which is even more remarkable. In fact, I'm going to walk this way for a second. I'm going to steal a copy of my book from the bookstore. I'm not even going to pay for it. Look at that. I just got it. Yeah, she's got me. She's got my number. Watch this. Watch this. Don't trust an economist. Watch this book disappear over the course of the speech. I just wanted to read briefly, because who wants to listen to an author reading his own book for very long? Just wanted to read. I've said most of this. I'm just going to read one paragraph. The Economist knows that the cappuccino is the product of an incredible team effort. Not only that, there's nobody in charge of the team. The economist Paul Seabright reminds us of the pleas of the Soviet official trying to comprehend the Western system. Tell me, he said, who's in charge of the supply of bread to London? The question is comical, but the answer, nobody, is dizzying. And that's one reason why economists don't understand the economy. It is a decentralized process of fantastic complexity, and nobody understands it. And, that's okay, because I think, and I hope I'll convince you, that there are still things that we can do, ways that we can respond to the economy, ways we can try to shape the economy, with the right degree of humility that makes some sense. But first of all, I want to explain why you should never trust an economist to tell you which stock to buy, or where a house is in an up-and-coming area, whether the property market's going to catch fire again or whether it's going to continue to sink. Never trust an economist to tell you this. And the reason, I think, is, well, think about picking the shortest line in the supermarket. This is a simple problem, okay? You look at the line at the supermarket, you look at the queue, you think to yourself, that line looks pretty short. I think, oh, no, maybe it's a bit oh, no, they've all got baskets. That's quick. And I see they've got cash. They're not going to pay with card. That should be quick. Oh, someone, like a grandmother with vouchers just stood in the line. Okay, that's no good. Oh, maybe there's a short line over there. That looks pretty short. Yeah, the cashier there, she's scanning fast. Oh, someone's in that line as well. Every time you stand there, you're trying to pick a short line. Every time you think you've seen a short line, someone else gets in it. And that's just fundamental about the way the system works. If it was obvious which was the shortest line, someone's standing in it, and it's not the shortest line anymore. And the same is true, in fact, it's more true of, say, company stock. If it was obvious that a company stock was cheap, well, there are an awful lot of people on Wall Street paid a lot of money to work that out and buy it. They are being paid millions of dollars to stand in the queue before you get there. And the same is true to some extent of property. If it's so obvious that this neighborhood is up and coming, why are they selling you their house? Yeah? Why are they selling you their house? It's not easy. You can get in the shortest line, but it's never going to be easy. It's never going to be obvious. And for the TV show, I tried to persuade people otherwise. Here's the result.
When you try to buy the most promising share, all you're doing is trying to pick the shortest queue. But so's everyone else. And if it's obvious which is the shortest, people will all move across, and it won't be the shortest queue for long.
You can see I'm in uniform here.
Thousands of professionals are all trying to find the same bargains. So of course, there are no predictable winners. If it were predictable, people would cash in on it, instantly changing the value of that share or property. That would cancel out any financial benefit. Economists call this an efficient market, which simply means that, like the queues, the market adjusts according to all the available information, and there's no clear advantage for anyone for long. So if I said I was an expert who could tell people which queue was guaranteed to be the shortest, would people believe me, or even pay me for my advice?
Excuse me, you're in this big queue, and I'm an expert on queues.
So I thought I could tell you whether you should move queues or not, if you're interested. But it will cost you £5. £5. We're willing to queue for a little bit longer. Okay, thank you. This is an absolutely titanic queue, and you're at the back of it. I am an expert, so I can tell you which queue is the best queue to be in.
It's a bit like the supermarkets, where you're always getting the wrong one with your trolley.
Exactly, unless you're an expert.
You can take me to the front then.
Well, I couldn't take you to the front, but I can tell you which queue to pick.
Oh, right, okay.
Yeah, if you're interested.
Okay, yeah, very interesting.
Okay, interested enough to pay? Will you pay like a fiver?
Okay, definitely.
Because you don't.
Any advice?
Because expert advice is never free. I could give you some advice as to whether. So I've studied, what type of person takes longest in the queue, which of these cashiers, which of these checkout people are quickest.
You don't get that much, do you?
Well, no, I don't. You don't think that I can tell you which is the shortest queue?
Unless you knew something I didn't know with the staff, but unless it's a new member of staff or something.
So if I had inside information,
Maybe.
then I might know. But just being an expert who thinks he knows about queues, you don't take that very seriously.
These people aren't stupid, and they quite rightly refuse to pay me for something I can't actually predict. So when a financial expert offers you a guaranteed hot tip, think first before you hand over your cash.
So you know all the reasons why experts shouldn't be trusted. The next time somebody promises to tell you about a cheap share or a cheap house, you should treat them with the same suspicion that these people treated me when I offered to point them to the shortest queue. So that's why you should never trust an economist to forecast anything. So is this a counsel of despair? Now I'm telling you that economists can't forecast, they can't make you money, can't tell you what the stock market is going to do, they don't understand the economy, it's too complicated, they can't even get you a date. I mean, what are they good for? But I think there are actually some valuable lessons from this way of understanding the economy. I mean, the first is that our natural tendency, which is if we see a problem with the economy, let's just put some guy in charge of it, and he'll fix it. So this is not a very wise way of approaching things. For a start, he'll probably ask economists to advise him, and then they don't understand, so things will go wrong. Now, I'm not one of those economists, and you will meet some of them. I'm not one of those economists who says markets are perfect, markets do everything. There was never any point in interfering with markets. They're just wonderful, and I don't believe that. That's not true. There's several books several chapters in the book where I explain first what you would have to do to actually see a perfect market, and just to understand what a perfect market would look like, you realize, oh yeah, so that would be never. Then we never have a perfect market. And then I explain what the problems are, why markets go wrong, and then what we might be able to do about them, rather than just sweeping them away and replacing them with some guy who will get it wrong, possibly even worse than the market does. So here's an example. If you try and drive your car through, or if you tried in 2003 to drive your car through central London, you would have noticed that the speed of traffic in central London is not very good. In fact, the speed of traffic in central London in 2003 was slower than the speed of traffic in central London in 1903, which is quite impressive. In 2003, the average speed was 11 miles an hour, and in 1903, when the roads were uncongested but populated by horses, the average speed was 12 miles an hour. So this is not good. And this is what what most of us would call a traffic jam or congestion. An economist calls an externality. Yeah? He calls it an externality, and it's a market failure. And the externality is, when I get in my car and drive, I am getting in your way. I am blocking the box for you. I am ahead of you in the queue for the traffic lights. I am taking up space on the road. I am switching lanes. I am causing trouble. I'm emitting pollution. I'm emitting carbon dioxide, lead, carbon monoxide, noise. I occasionally run over toddlers, that kind of thing. I'm causing trouble for everybody else. Now, maybe not a lot of trouble, but some trouble. Okay? In fact, actually, not a lot of trouble. It's important to bear this in mind. I'm just causing a little bit of trouble. However, with another 500,000 million
drivers on the roads of London, all causing a little bit of trouble, that all adds up to a big amount of trouble. It's a problem. It's a market failure. Now, ordinarily, most of what we do actually causes other people trouble. If I buy a cappuccino, I'm causing trouble. There's some person who would be quite happy to be watching a movie, hanging around at home, who's had to put on a stupid uniform, get up early in the morning, come to the Starbucks and make me a cup of coffee. I walk in, I say, "Cup of coffee, please," and they just have to make it. They don't know me. They start to make me a cup of coffee. People work very, very hard growing the coffee beans. People work very, very hard raising the cows, milking the cows. For this cappuccino, people are going to a lot of trouble. I am causing people a problem. But it's not a market failure. It's not the same kind of problem as with a traffic jam. And the reason is, I pay. I pay Starbucks. Starbucks pays the barista. They pay the coffee manufacturers. They pay the dairy farmer. They pay. Everybody along the line gets paid for their trouble. But if I block the box and you're 5 minutes late for work because I was on the roads, I don't pay you 5 minutes. I don't pay you at all. You don't get anything from me. But there is a way of giving the markets a little bit of a hand. You can implement some kind of tax or charge on using the roads. And this is something that they did in London. And I want to emphasize it's not going to work everywhere, but it works in London. He put a perimeter around central London. He said, if you want to drive in on a weekday, it's going to cost you £5, which is $10. And they put it up, $12. And they're going to put it up again, it's going to be $18. Yeah? It's going to cost you. And you know what? 90% of drivers paid. And they got something for their money. They got to work in 20 minutes instead of an hour. So you paid $12 and you saved 40 minutes of time. And you can understand, for a lot of, actually you saved 40 minutes each way, so you saved over an hour of time. So if you're paid more than $10 an hour, it's actually not a bad deal. Yeah? And you can see a lot of people paid, maybe didn't pay happily, but they got something for their money. And then a few people stopped. And the funny thing was, it only took 10% of the drivers to stop for the speed of the traffic to move up dramatically. Suddenly you found congestion had fallen very sharply, average travel times had risen, average speeds had risen, travel times had fallen. The predictability of how long it was going to take you to get there had also improved. So instead of being, well, maybe an hour, maybe two, it was, well, half an hour and definitely not more than 40 minutes. You know, you would have and that really helps. So this was tremendous value to the citizens of London. The interesting thing for me is you could get that effect in another way. You could, for instance, say, if your car registration number begins with A, B, C, D, or E, you can't drive on Mondays. If it's F, G, H, I, J, you can't drive on Tuesdays. You can try and legislate some other way, or you can try and make parking expensive, or you can try and gum up the roads. But none of these systems work nearly as well, because for a start, we don't know which of those journeys are important. I mean, that person whose car registration begins with B might have a very, very important meeting to get to, or maybe they're in labour, or whatever. We don't know how valuable that journey is to them, and we've just said you can't travel on a Monday. But with the congestion charge, you know, if it's more than $12 of value to you, you do it. If it's not, you don't. We also don't know the best way for people to get around the congestion charge. So there are different possibilities. You could drive around central London. You could carpool. It doesn't save you the congestion charge, but you split it, obviously. You could cycle. You get a moped. You could buy a Prius. You could catch the bus, which, of course, is now flowing a lot more freely because there are fewer cars. You could get on the London Underground. You could get a train. You could change your job. That sounds ridiculous, right? But we change our jobs on average once every 3 years. So maybe you don't change your job immediately, but then an opportunity for a new job comes up and you think, hey, that job, I wouldn't have to pay the congestion charge. That's worth something. You could telecommute. You could go to your boss. You could say, you know, this is costing me $12 every day. If I could work from home on Fridays, that would help. And the boss might be like, actually, there's no reason. Why not? Of course, if you work in Starbucks, the boss isn't going to go, sure, you can work from home on Fridays. But that's the point. We can't, some bureaucrat says everyone can work from home on Fridays. That doesn't work. But each individual business, each individual is getting the signal from the price, and they can respond to that signal however they want. So you're keeping that decentralized nature of the economy. And I think it's worked very well. And it's not just congestion that you could deal with in this way. I think the general approach of trying to use markets as much as possible and trying to behave with humility towards the economy, because it's a complicated thing, has paid dividends, not just in the UK, not just in the US, but in places like China as well. And in the last chapter of my book, the whole book I just mooch around, going into Starbucks, going into Whole Foods, getting stuck in traffic jams, doing everyday things. That's why it's the undercover economist. It's just me, just an ordinary guy wandering around, but looking at things using economics. In the last chapter of the book, I'm doing exactly that, but I'm mooching around Shanghai and Beijing and trying to work out how I interpret what I see there. And the story is very interesting. You had a country where, at the end of the 1970s, they were producing less grain than they had produced at the end of the 1940s. You had 30 million people die in a famine in the 50s. If you see the world population graph, you can look this sort of thing up. Just look, you can see the drop in the population of the world because of the famine that hit China. The famine that hit China was caused by one guy saying, you know what, I think we should grow our crops in a different way. It would be better to plant them more closely and do it like this and blah, blah, blah. And so he's Mao, and no one wants to tell him it doesn't work. And when it starts to fail, the crops start to rot. No one tells him. When he goes on a tour to look at the crops, they stack them all up. They have fans installed in the fields to keep the air flowing so the crops aren't rotting. Everything looks great to him. He's getting no feedback from the economy. When people start starving, the government is increasing its exports of grain to other countries because there's no famine, right? There's no feedback in that system whatsoever. Contrast that to what happened at the end of the 1970s, where Deng Xiaoping came to power, and he just said, you know what, you guys might want to try something different and we won't stop you. That was all he said, we're just not going to stop you. And a few local areas experimented with the radical idea that if some farmer grew extra rice, he could keep it. He could sell it to somebody else. He could do what he wanted. So suddenly there's an incentive to work harder or to innovate, come up with new ideas. And you know what? A lot of people didn't respond to that incentive. It was just some people who did. That was enough. And in 1979, 2% of Chinese farmers were under that system. And by 1983, 98% of Chinese farmers were under that system. They tried it out. It worked. Suddenly, okay, fine, let's go. Let's not wait around. It worked. And China has been, I think the right word for, people describe Chinese reforms as gradual. I think maybe that's the wrong word. Empirical, maybe, experimental. They keep trying things. If it works, they do it. So the same thing with a manufacturing base. You've got a coal mine producing 10 tons of coal, ordered by the government plan to ship the coal to the steel mill, which will use the coal to make 10 tons of steel, and then the steel will be shipped to a construction site, all written down in the plan. And about 1984, they said, you know what, if the plan says 10 tons of coal and you can make 11, and you can find someone to take the last ton of coal, that's okay. But first, you deliver according to the plan. The same with the steel mill. If you can produce an extra ton of steel, you can find someone to take that extra ton of steel, you do it, but first you do what is specified in the plan. And that means that everybody kept their jobs, there was complete security, everybody knew what was going on, they had the plan. A coal mine that was inefficient, that was badly run, wouldn't be able to expand, wouldn't be able to deliver more coal. A steel mill that didn't work very well wouldn't deliver more steel. But some of these places were just sitting around going, well, we could produce 50 tons, but the plan says 10. So we just produce 10. And suddenly they produce 50. So all the efficient factories are starting to expand. And yeah, there are places operating that, by the strict logic of the market, should be closed down. But they're kept open, but the cost of that is tolerable. And you have this experimental process, and after 15 years of this, the plan, which has not changed for 15 years, is so tiny, they just rip it up and throw it away and no one even notices. It's an experimental strategy. And it's a strategy that has had a big effect on the lives of a lot of people. And economists like to talk about economic growth a lot. I think there's something more important than that going on. I recognize that what's happened in China has caused a lot of pain to a lot of people, including in China. What I argue in the book is that not that this is a good thing, not that this is not something we should worry about, but I just list the alternatives, none of which I can see are any better. And the progress, the fact that this is a temporary situation, that we are moving in the right direction. That's something I argue. But, I can quote all the statistics, but I'm more interested in the people. So let me just read you the last page of the book, and then I've read you the first page, I'll read you the last page, and then I'm very, very happy to take questions. In the end, economics is about people, something that economists have done a very bad job at explaining. And economic growth is about a better life for individuals, more choice, less fear, less toil and hardship. Like other economists, I believe that sweatshops are better than the alternatives, without a doubt, better than starvation under the Great Leap Forward or life in modern North Korea. But if I did not also believe they were a step to something better, I would not be such an enthusiastic supporter of China's reforms. And that's why I was cheered by the latest news from China. The wealth hasn't been evenly spread, but it is slowly seeping inland from the Gold Coast of Shanghai and Shenzhen. Between 1978 and 1995, 2/3 of China's provinces grew faster than any country anywhere in the world. Most importantly, the people of China are feeling the difference. After years of paying low wages, because the supply of migrant labour from China seemed unlimited, factories on the Gold Coast are starting to run out of willing workers. Foreign-owned factories pay a bit more. They enjoy easier recruitment, lower turnover. But wages will have to rise, conditions will have to improve, because inland China is catching up. In 2003, Yang Li did what many Chinese workers have done. She left home to work in a sweatshop in the Pearl River Delta. A month later, after working 13-hour shifts, she decided to go home and start her own business, a hair salon. Every day at the factory was just work, work, she says. My life here is comfortable. Yang Li's parents had to survive the Cultural Revolution. Her grandparents had to survive the Great Leap Forward. But Yang Li has real choices, and she lives in a country where those choices mean something for her quality of life. She tried factory work. She realized it wasn't for her. Now she says, I can close the salon whenever I want. And economics is about Yang Li's choice. Thank you very much. Now, we have time for questions. I'd be very delighted to take some. So.
Thank you, Tim. First of all, do you realize you're confounding the issue with your facts and logic? Were you aware of Michael Pollan's book, The Omnivore's Dilemma?
I've heard of it. I haven't read it. Yeah.
He actually brings up a classic bait and switch where ethanol and corn, there are hidden costs in growing corn.
Mm-hmm.
It takes barrels and barrels of oil
Yeah.
to produce corn. That's a classic bait and switch.
Yeah, I think this is important. It's very easy for us when we're facing, say, an environmental problem to try and legislate a solution. So we say, okay, we'd like some subsidies for corn farmers. And then you go, well, hang on, you could subsidize corn farmers so you could grow biofuels, but is that, how much energy does it take to grow the corn? Well, hang on, why don't we just import the sugar from Brazil? That's a much cheaper, much more effective way of producing ethanol rather than producing it from corn. Well, no, we can't do that because we have tariffs. We don't want Brazilian sugar because, well, I don't know why we don't want Brazilian sugar because we want to favor a small number of very rich men in Florida, and the rest of us want to pay a lot of money for our candy. I don't know why that works, but actually I do. But that's another subject. We push and pull and start and tax breaks for these guys and push, and some of it may work and some of it may not. But I know what will work, which is a tax on gasoline, a tax on crude oil, or best of all, if you're worried about climate change, which is I think what's behind a lot of this, a tax on emitting carbon. You have a tax on emitting carbon. Okay, now, all of us at that point, I suspect this is not exactly how the tax would work, but if we had a tax on emitting carbon, all of us would be paying for breathing. Yeah, we're emitting carbon dioxide, we are contributing to climate change, we should pay the tax, okay? But I can guarantee that every single one of us would say, okay, I'll pay. Because that's a very high value use of carbon dioxide. And you know, a lot of what we use carbon dioxide for, a lot of what the byproducts of carbon dioxide, they're very, very valuable. And we would pay the tax. And by the way, when we pay the tax, the money isn't wasted. This is money we could use to pay off the debt, or it could be used to reduce income tax. I mean, I've never really understood why we're so keen to tax people for doing good things like making money, and we don't want to tax people for bad things like, you know, clogging up the roads and burning energy. I don't know why that, but that's the way it works too. At least that's the way it works in the States. If you give people that signal, then to use a terrible bit of jargon, the low-hanging fruit gets picked. Like, we could make the cars more efficient. That's easy. We could make one trip instead of 2 trips. It's easy. We could insulate our houses. Easy. Maybe what happens is we see some new sources of fuel. I suspect a lot of it would just be plain simple energy conservation. But we keep the choices with individuals. Is it important for me? Is this important for my lifestyle? Do I value this? Is this important for my business or for the pleasure I take in just being alive to pay this tax? If so, I pay it. But if not, I don't pay it. And that is going to work a lot better than regulatory measures to push and pull certain special interests. Thanks for the question. There was a question right over here. Can we have one and then we'll come back for the second one if there's time? Okay, so you've cheated and asked 2 questions, but they're good questions. That's fine. Okay, on the ecological impact. The ecological impact of China's growth so far has been dramatically positive. It won't be forever. The reason it's been positive is because under Mao, you had unbelievably wasteful uses of energy. So, you know, your industrial program is take good steel, melt it down in your back garden using a coal-fired furnace with no filters, to make bad steel, which is then useless. You know, repeat until necessary, because that's what Mao tells you to do. Now, you can get rid of that and grow your economy and emit less pollution. That's easy. So we've had this one-off hit in the 1990s, a big fall in the emission of carbon dioxide from China, big fall in urban air pollution, which I document in the book. We're not going to have that again. For the next 15, 20 years, China's rise is going to have an environmental impact, for sure. Now, historically, what we have always seen is that from the pollutants, whenever a country gets rich, it is able to cut down on the pollutants that really matter to our quality of life. Not by magic, by legislation, but by legislation that is demanded in a rich country. Yeah? We know how the waterborne diseases, pesticides in the US, we had Carson, Silent Spring, all this stuff sort of damped down. We have much, much cleaner air now. The same thing in the UK. Thousands of people just dying of smog pollution in London in the 1950s. Just changed the law because we were rich, because we could afford to do it. The Chinese, when they get rich, will also do the same thing. So the other question is about, sure, how many people have these choices? Well, I don't know the answer to that. I don't know the numbers. What I do know is where they came from. Terrible poverty, the terrible oppression. And we see the sweatshops in the United Kingdom, first of all, world leaders in sweatshops, we got there first, in the United States, then we see them in Japan, then we see them in Taiwan, then we see them in Korea, and they all go away when the country gets rich. They all go... well, we don't have people working for 50 cents a day. We don't have people working for 50 cents a day. This is a country that is getting richer. So behind the question is, could you somehow legislate to make these sweatshops go away? And I think the answer is only to a limited extent. I mean, we could legislate I don't think I was paid enough money for my book. And we could legislate that I should be paid $1 million for my next book. And we know what will happen. I will not get a book deal. Yeah? Now, to a certain extent, you can legislate to improve conditions in a very poor country like China. At a certain point, that legislation becomes very counterproductive because no one wants to go to China anymore. We could say all Chinese workers have to be paid $10 an hour. And I guarantee you that all the money would leave China and they would all be paid nothing. So, and finally, I guess I point to the poorest place in the world, which is Africa. There are no sweatshops in Africa. I visit Africa, I talk about the African experience in my book. There is no globalization in Africa, there are no sweatshops, no one's interested, it's just not worth, even if they work for nothing, it is not worth anybody's while to do business with Africa, which sounds incredibly harsh. That's just a description of the reality. So I look forward to the day when African governments are able to provide an environment where we get sweatshops in Africa. Not because I want to see sweatshops, because they are the step on the ladder. And I don't think there's ever been a country that has become rich without going through that process first. So these are serious and good questions. Thank you. Yes, ma'am.
I'd love to hear your thoughts on health insurance and health coverage in the U.S. I know in your book you talk about the Singapore model.
Yeah.
I just wondered if you had any more recent thoughts on
Yeah, I mean, the thing that really strikes me about health insurance here is we have too much and too little. Okay, so we have too much because we're insured. If we have insurance, we're insured for everything. This is a little bit like having insurance for, you know, your auto insurance. You want insurance against theft, right? You want insurance against crashing the car. Do you want insurance against having to fill your tank up? Insurance against replacing your tires? These are not things that we want insurance for, because these are totally predictable expenses. And if you imagine a world where you had insurance to fill up your tank, well then you're not paying the cost of filling up your tank. So what do you think the experience of going to a gas station is going to be like? Well, you're going to drive in, the valet is going to take your keys, you're going to sit down in a nice cushy waiting room, you'll be fed coffee. This is going to be like going to the doctor, right? You get nice free coffee and magazines to read and all this glossy stuff while they fill your car up, and they'll charge you $15 a gallon for the gasoline, but you don't care because you're not paying the bill. This is not a way to encourage price sensitivity and sensitivity to cost effectiveness. So we don't want insurance for that. And I think we should be paying for that out of our own pocket. And then you have this problem that you have 45 million Americans that don't have insurance at all. And I think that those two problems are linked. So I think that it's a very hard problem. Yeah, this is a very hard problem. There are lots and lots of reasons why the market for healthcare doesn't work very well. But I think that we could make it work better. I think it needs some government subsidy, a good chunk of redistribution to make sure the people at the bottom have enough to pay for basic healthcare costs. Everybody should have insurance for the lung transplant, the heart attack, the serious costs. And I don't think anybody should have insurance for a regular checkup. People are prepared to pay. You know, you don't need insurance to go to Whole Foods or Safeway and buy food. You know, you just do it. You don't need insurance. You do it. And I think the same should be true of these regular predictable expenses. So that's my suggestion. But with humility, because economists don't understand the economy. It's a question here.
In the fire, it said why you can never get a good, decent used car. So I was wondering if you
Could I please explain why you can't get a decent used car? Actually, somebody spoke to me just before the speech, and she said, well, I don't know what an economist thinks, but as far as I'm concerned, you can't buy a decent used car because anybody who has a decent used car won't sell it. And she's completely right. But actually, what's behind the process is something that economists calls adverse selection. So the idea is, it would be fine if like Andy, our hapless playboy with a medallion, if you could prove your quality to the world, then you'd sell a good used car. Sure you would, because you'd get a good price. And you'd sell a bad used car as well, and you'd get a bad price. And they would both be a fair price. The problem that we have, I mean, if you imagine restaurants as an analogy, you know, you can go and eat at a really fancy restaurant, you can go and eat at McDonald's, you've got the choice, because you can see the quality, you know what you're paying for. But with used cars, the buyer is not sure of the quality. The seller does know the quality. The seller would love to convince the buyer that it's a great car, but the seller is not able to prove it. And if the seller's not able to prove it, the seller won't get a good price. And if the seller doesn't get a good price, the seller will hold on to the car. So if you want to buy a good used car, you find somebody who you trust a lot, or you find someone who is moving to a different country or something, or for some reason actually has a real reason to sell the car other than just it's a terrible car. That's how you buy a good used car. The interesting thing for me is that actually this applies not just to used cars, but it applies to all kinds of parts of the economy. So it applies to healthcare insurance, I write about in the book. It also applies to getting a job. And let's say you're smart, hardworking, honest, and you have no way of demonstrating these qualities to an employer. Well, in that case, maybe you set up your own business. Let's say, on the other hand, you're stupid, lazy, dumb. Not you, sir, but people you may know. Well, they have no way of the employer has no way of determining whether you're good or not. So the good people go off and be entrepreneurs, and the idiots get hired by bureaucracies, which I think explains a great deal of our daily experience. So yeah, I'm exaggerating, but there is something of this in the used car market, something of this in personnel economics, and something of this in health insurance as well. Thank you. I think we've time for one more, maybe two more questions, quick ones. So, sir, and then, yeah.
Yes, what about behavioral economics? I'm an economist.
Mm-hmm.
For example, the efficient market theory, Warren Buffett, when he was asked is the market efficient, he said, some of the time it is. And we have like stock market bubbles, for example, in one of the early
Yeah. Yeah. I mean, the market's pretty efficient. I mean, yeah, it's not efficient, but good luck beating it. Buffett does it, but others don't. But yeah, you're right. There's a big literature now which is getting a lot of press on behavioral economics that comes up with all kinds of examples as to when people do not behave the way that economists predict they should behave. And I think this is very interesting literature. It gets a lot of coverage. People like economists to be wrong about stuff. I question some of it, though. You have to get the next book for my take on some of this. But here's an example. The behavioral economics literature says if you're hiring somebody, there's no way that you would pay them more than the going rate. You pay them the market rate. Why would you pay them extra? And if you happen to get a job paid with a really generous salary, that much more than you really need to do the job, then you would just goof off the same as anyone else, and you'd just take the money, and what suckers they were for paying you. That's the standard economic view. Now, the more common sense, intuitive, behavioral economic, psychological view is no. If someone is paid more than they need to be paid, they will be grateful and they will work harder. This is called the gift exchange theory. And there's some great lab work that shows that this is how people behave. Employers often offer higher wages than they need to, and workers, in gratitude, work harder than they need to, and so actually it turns out in retrospect to be profit maximizing for the employers, and it all makes sense. The trouble is that these lab experiments, they don't actually involve anybody doing any work. I mean, when I say employer, I mean employer, and when I say employee, I mean employee, and these are people just ticking boxes and saying, yeah, I'll pay the employee $15 an hour. And that costs them some money. They're in the experiment. There are some financial incentives. And then the employee gets a thing and it says, well, the market clearing wage is $10 an hour, but you are going to be paid $15 an hour. And what do you want to do? And you go, oh, that's generous. I will work hard. And they tick a box. They don't work. They just tick a box. It costs them some money. They have to pay money, but, that's what they do. So an economist at Chicago called John List, I'm a big fan of his, said, okay, fine, that's very interesting. I wonder what happens really. And what he did was he piggybacked on a temping agency, and they were hiring people to go doorstepping for charity, door to door, trying to solicit donations, and also another group of people who were doing data entry in the library. And so for each of these groups, they were offered $8 an hour, $12 an hour, whatever. And they agreed. And then for half of them, they'd chosen at random, he would go in and say, great news, you agreed to do this for $10 an hour, but actually I'm going to pay you $15 an hour. Now, off you go and good luck. And what he found was people do, in gratitude, presumably, work harder when they receive the $15 an hour. Until lunch. The effect lasts 90 minutes for data entry clerks, and it lasts until lunch on day one for charity doorsteppers, and then they go back to being the stupid, work-shy, goofing off employees that you would have expected, and the effect just evaporates. So behavioral economics is interesting. I'm sure that some of the results that they find are real. I'm also sure that some of the results they find are not real. And there is quite an interesting counter-literature of things that you see in the laboratory where when you actually go into the real world and try and replicate it, it turns out that people are a little bit closer to the rational economic man than we really like to think. I'm afraid I talked too long and I don't have time for the last question. So thank you very much. It's been a great audience. I appreciate it.
Thank you very much.
This has been a presentation of the Library of Congress. Visit us at loc.gov.